Hello, everyone, and welcome to the 6th International Conference on Economic Management and Green Development. My name is Tran from Base Business School, formerly Cass Business School at the City University of London. Today, I would like to talk to you about firms' decision to innovate organically versus through acquisition, with some evidence from state R&D tax credit. And this is joint work with Jennifer Bluin from the Wharton School and Alice Fish from Drexel. Just a bit about the background. Innovation is basically critical to firm growth. Firms that innovate increase their productivity and efficiency, thereby increasing their potential profitability. As innovation is good for economic growth, jurisdictions often provide tax benefits to incentivize such activities. For example, many countries offer research and development tax credits to incentivize R&D in their locales. Although these credits reduce the tax burden of the underlying business, jurisdictions benefit in the long run through the growth of the business profit. And ultimately, there are two ways for firms to increase their innovation. They may undertake R&D themselves by, for example, hiring skilled workers or setting up labs. They can also increase aggregate innovation by acquiring other innovative companies. M&A, merger and acquisition, effectively allows companies to outsource R&D activity to other firms, but it is unclear whether buying innovation signals strength or weakness in the prospects of the acquirer. Seru 2014 argues that not all acquired innovation is used efficiently, as the success of the acquired innovation appears to hinge on the ability of the acquirer to capture the innovation's potential. A firm eligible for lucrative state incentives that choose to engage in R&D via acquisition may be signaling that its own R&D prospects are actually poor. Because once the firm chooses to engage in M&A, it potentially reveals that its own R&D investment opportunities may be more limited than the market anticipated. While pursuing the growth by acquisition likely increases the firm's M&A activity, such behavior could actually end up having a detrimental effect on the overall value that investors place on the transactions. So our research question is, what do firms' investment decisions actually reveal in the presence of incentives that promote organic growth? We obtained more than 100,000 firm years for more than 9,000 unique US firms from the standard database GRIS CompuStat during the fiscal years 80 to 2016. We obtained patent applications filed with and ultimately granted by the US Patent and Trademark Office. And we matched those observations with information from Security Data Corporation M&A database to find which firms that actually issue an acquisition bid during the sample period. And we used a sample of almost 8,000 completed US domestic M&A deals made by around 3,600 unique US acquirers during the calendar year 80 to 2017 to study the effect of state R&D tax credit legislation on acquisition performance. Let me just give a little background on the R&D tax incentives. Governments in many countries actually seek to promote R&D investment in the economy by granting a preferential tax treatment to eligible R&D expenditures, especially those incurred by firms. In 2016, 29 of the 35 OECD countries, 22 out of 28 EU countries, and a number of non-OECD countries actually offer R&D tax incentives. The US actually ranks 8th in terms of the total volume of government R&D support, 25% of GDP. Tax incentives actually account for 28% of total public support for R&D in the US, and R&D tax support actually increases from 8.7 billion to 10.7 billion from 2000 to 2013 in the US. One trouble with studying the association between R&D and M&A value is that it is very difficult to place any ex-ante value on an acquirer's pre-deal R&D activity. Moreover, we cannot value R&D that is not undertaken by the acquirer because it chose to acquire it instead. So we focus on the relative cost of R&D activity. And the difficulty with studying the role of taxation on investment is that the federal level taxation affects most firms in the same manner. So to overcome the identification challenges, researchers have begun studying the largely exogenous staggered changes in state tax incentives. So during the period 1980 to 2017, 39 states in the US actually implemented a state-level R&D incentives. So once the state adopts the R&D benefit, it normally maintains the program, and the amount and the mechanics of R&D incentive sometimes change during the time period, and some states actually even terminate their R&D incentives. And states' R&D tax credit amounts are mostly based on the incremental growth in R&D expenditures conducted within the states. And the state's tax credit rates for qualified research expenditures varies from a low, let's say 3% in Colorado to a high of 20% in Hawaii. And in some states, R&D tax credit is broadly refundable in case it exceeds the tax liability. And among the states without refundability or with only limited refundability, the unused amounts of tax credits can be carried forward from a minimum of 3 years to up to 99 years. So the law on tax credits by each state is quite complicated. And this table actually shows the individual US state R&D tax credit law adoption and expiry year, and the number of M&A deals in each year. The earliest states that adopt the law is Minnesota back in 1982. And the law was adopted, but then expired in some states such as Michigan, North Carolina, Wyoming, and the law is never adopted in some states, for example, Alabama, Kentucky, Missouri. So in our research design, we have a few variables of interest. The first one is the R&D tax credit variable. So we have 3 variables. The first one is R&D tax credit rate. Is this given by the state in which the firm is headquartered and which has passed the R&D tax credit law by the firm fiscal year end, and we put it to 0 otherwise. And the sample mean median tax credit rate in our sample is 10%. The second variable is the R&D's tax credit value, which is the rate from the first variable. We multiply that by the firm's average R&D spending in the most recent 3 years, and we put it 0 otherwise. And the third variable is the R&D tax credit carried forward, which is the number of years for tax credit carry forward given by the state that the firm is headquartered. And it is set to 100, basically 100 years, if the tax credit is refundable in case it exceeds the tax liability. And for the outcome variables, we have the innovation variable, which is the number of patents granted to the firm scaled by the asset. M&A activity variables, we include the probability of making a deal in a given year, the number of deals, and the total deal value. And M&A performance, we include standard variables that the acquirer announcement return, post-deal operating performance, offer premium, and deal synergies. So first, we evaluate the relative contribution of innovation activity to the market value of the firm. So all else equal, firms with a lot of presence in the state with more generous R&D tax credits should be able to conduct R&D activities at a relatively lower cost. So the contribution of innovation activities to the firm value should increase with the tax benefit. So to test that relation, we use 6 different models. that use Tobin's Q, which is a proxy for firm value, as the dependent variable. And then we run that on the R&D tax credit variable, innovation variable, and the interaction between innovation and tax credit. And all regressions control for unobserved firm heterogeneity, time-varying differences across states, across industries by including firm, headquarters states, year, and 3-digit SIC industry by year fixed effects. Just to briefly show the result here. So if you increase the tax credit by 10%, it's going to be associated with a 0.83% increase in Tobin's Q. And the interaction term between the R&D tax credit and innovation shows a stronger positive effect of R&D tax credit on the contribution of innovation to firm value. So the takeaway from this result is that firms with patents actually reap important benefits from state R&D tax credit programs. So ex ante, it is very unclear how state R&D tax credits will affect M&A activity. Because on the one hand, with the state subsidizing R&D tax credit for internal organic growth, firms actually don't need to innovate via acquisition. But on the other hand, firms use state R&D tax credits as an opportunity to reduce the acquisition cost by moving the target's innovation activity to tax credit qualifying states. So to test the relation between M&A activity and R&D tax credit, we modeled a couple of regressions in the similar way as the previous innovation test. So we run M&A activity on R&D tax credit, and we include the fixed effects as in the previous models. Again, our M&A activities proxies include the probability of making a deal in a given year, the number of deals, and the total deal value. This table shows the result of the M&A activity test. The coefficient here in model 1 shows that raising the state R&D tax credit rate by 10% is related to an increase of 0.23% in the probability of making an acquisition in a given year, which is about 5 percentage points compared to the 4.7% unconditional probability of making a deal in any year. And this is an uptick of 1.5% in terms of deal value. So the takeaway from the M&A activity test is that firms headquartered in locales or states with more generous R&D tax credit programs are more likely to pursue M&A deals and to spend more in those transactions. We also investigate whether there is any evidence that acquiring firms appear to move targets R&D activity into more generous R&D tax credit states. Although we can just provide some kind of indirect evidence, we compare the patent activities of acquirers headquartered in state with R&D tax credit program, which is the treated cohort, with M&A deals by acquirer headquartered in the states, other states, which are the control cohort, both before and after their respective M&A transactions. And then we plot the estimates of the patents in the period surrounding the M&A deal according to the acquired state credit eligibility. So from the year before the acquisition to the year after the acquisition, the patent counts increased to 10.86 for acquirer in R&D tax credit states, the red line. For other acquirers, the average increase is only 6.86 for the other non-R&D tax credit states. So the difference in the means is statistically significant at 5% level. But 2 years after the M&A, the mean difference in the patent count between the two groups is no longer significant. So we think that the relatively quick increase and dissipation of the patent activity is more suggestive of a shifting of the target existing successful R&D activity rather than any incremental R&D activity generated through the combined firm. So while it's unlikely for any individual firm that the tax credit is large enough to incentivize any M&A transactions, it is possible that the firms with limited or internal growth potential need to acquire to keep pace with other R&D tax credit recipients that use those incentives to fuel their organic growth. So do firms spend more or less in R&D when having made a bid and enjoy tax credit? So we model R&D spending on R&D tax credit. Whether the firm make a bid, whether the firm make a bid when receiving tax credit, and which is the interaction term between bid and R&D tax credit in this model. So to sum up, for this model, we need to know whether the investment choice that manager make actually reveal some new information to investors on the firm ability to finance the investment and on the range and the quality of the firm's investment opportunity set. We want to see whether the R&D spending for the firm is going up or down in the presence of R&D tax credit, and whether the firm is choosing to make an M&A acquisition instead. So this table shows you the result. The first coefficient here on the standalone bid variable show that the bid 01 dummy implied a 0.2% increase in R&D spending in the firms that actually bid for a takeover target. But the interaction between the bid and R&D tax credit actually shows that for bidding firms in tax credit states, increasing the R&D tax credits rate by 10% is associated with a 0.17 reduction in R&D. So firms appear to redirect resources typically invested in organic growth, which is R&D spending, towards growth through M&A. So to gain further insights on this issue, we explore whether acquirers in general state R&D tax credit jurisdictions are likely to pursue innovation-intensive targets and then increase the initial offer. So we model the probability of the acquirer buying a high R&D target and whether the acquirer is revising the bid offer upward. So we find that an increase in 10% in the tax credit rate is associated with about 2% increase in the probability that the acquisition actually involves innovative target. So the acquirer here is buying the targets that are very innovation intensive. And it's also associated with about 3% increase in the probability of an upward offer revision. So overall, we find that acquirers in general state R&D tax credit jurisdictions are more likely to pursue innovation-intensive targets. So while some firms in states with large R&D tax credit incentives are more likely to grow via M&A, the same firms might be pursuing organic growth. But we also find a reduction in R&D spending for firms that actually made an acquisition bid. But then such a reduction may be justified if the M&A is a superior investment. So to understand this issue, we examine whether the deal that those acquirers are making is a good deal. So we look at M&A performance. So we regress various measures of deal performance on our R&D tax credit rates. We find that raising the state R&D tax credit rates by 10% in Model 1 here is related to about a 0.3% reduction in the acquirer M&A announcement return. Such a drop translates to a decrease of around 16 million in the market capitalization, market value of equity for the average sample acquirer. And a 10% increase in the state R&D tax credit rate is also associated with a 0.25% decrease in the operating performance of the merged firm, a 5% increase in the offer premium, and a 0.56% decrease in the deal synergy. So overall, we find bad performance of acquirers in general state R&D tax credit jurisdictions. So the deals that those acquirers are making are not good deals. So do acquirers actually headquarter in those areas with tax credit actually relocate the target's innovation activity to the headquarter location to claim the tax benefit? So that's the final evidence that we want to uncover. So then we matched our sample with the National Establishment Time Series database, which provide very detailed subsidiaries information about the sales and the employees across the states. And to cleanly identify the timing of the effect, we actually construct cohorts of acquirer enjoying R&D tax credit and the acquirers that don't enjoy the tax credit for 6 years around the acquisition event, 3 years before and 3 years after. And then we pull those data across cohorts. It regress the outcome variable, which is the sales or the number of employees on the year's indicators. Firm cohorts, headquarter, state cohorts, and industry using fixed effects. And the acquisition year 0 is omitted so that the effect is measured relative to the acquisition year. So the graphs here shows you that, so let's look at the left side plot, shows that in year 1 year after the acquisition, all right, the volume of sales actually rise by almost 9.8% for the R&D tax credit acquirers, but only around 6% for the non-R&D tax credit acquirers. The difference is statistically significant at 1% level. And on the right-hand side, the employees graph shows that in year 1, the number of employees increased by almost 8.5% for the R&D tax credit acquirers, but only 6% for the non-R&D tax credit acquirers. And the difference is statistically significant at the 5% level. And notably, as with the number of patents for R&D tax credit in the previous figure, the 1-year surge in the sales and employees actually subsides over the subsequent 2 years. So these results provide evidence consistent with our conjecture that the rise and the ensuing dissipation of the patent activity suggests the shifting of the target existing successful R&D activity to the headquarters of the acquirers in locations with R&D tax credit program. So to conclude, innovation is key to firm growth, but the decision to innovate organically versus through acquisition is not very well understood. By using state-level R&D activity, we examine whether firms that are able to undertake R&D for relatively lower cost are penalized by the market when they purchase innovation instead. Because these state-level incentives actually reduce the cost of R&D activity, we investigate whether firms that purchase innovation are effectively revealing that their internal R&D activity is relatively poor. So overall, our totality of the evidence here is consistent with the view that the decision to grow via M&A in the presence of incentives that promote organic growth reveals that the firms has basically inferior internal investment opportunities. As a result, state-level R&D tax credit incentives here are associated with increased M&A activity involving transaction that destroy substantial value for the acquiring firms that enjoy this R&D tax credit benefit. All right, so I hope you find the speech interesting. And if you have any questions, feel free to let the organizer know, and then I'll reply at the website. Thank you very much for your attention.